Very happy to welcome to Forward Guidance Luke Gromen, founder of Forest for the Trees. Luke, great to have you on Forward Guidance. We are recording in the middle of a pretty severe sell-off in the bond market. TLT is down close to what, 1.5%, 2%, and the 10-year is now above 4.5%. Is it fair to say the bond market is melting down? Is that too dramatic a phrase? And how bad do you think it will get?
I think it's too dramatic to say the bond market is melting down right now. I don't think it's too dramatic to say that unless the dollar is weakened meaningfully or unless oil is lowered meaningfully, the bond market will melt down.
What does meltdown look like?
Meltdown to me looks like a version to the TLT doing a version of what Repo did in September of 2019, which is 2%, 2.2, 2.58. 10. Oh crap. Fed comes in 48 hours later with not QE, puts it back to 2, and away we go.
And how much of the sell-off in bonds is due to economic conditions? So, growth being more resilient than expected. How much of it do you think has to do with supply?
I think it's mostly. Um, I don't think it matters, and that's I think the part that people don't get. It's probably because it's like which snowflake touched off the avalanche and killed you and your entire family while you were skiing? Like, who gives a shit? You're all dead. I think initially it's better growth. And the reason why I say it doesn't matter is because there's first and second derivatives to this that people still don't understand. They obviously don't understand based on things they're saying, writing, etc. Okay, what do I mean by that? Yes, growth is better. Okay. Why is growth better? Well, not because housing's better, not because ISM's better, not because services is better. What's better? US federal spending, which is 25 on its way to 30% of GDP, is up 15%. US federal outlays are up 15% on a year over year basis. Usually only happens in a recession. US deficits are at almost 8.5% of GDP on a trailing 12-month basis. Only ever happens after recessions. Or in the middle of recessions. It hasn't happened with 3.5% unemployment like ever. And that's why I say I don't think people understand the second derivative of that question, which is it because growth is better? Yeah. Why is growth better? Because deficits are so darn high. And why are deficits so high? Because rates are rising. And that's people don't understand. We're in this feedback loop. Well, growth is better. Well, yeah, growth is better because friggin' deficits are at 8.5%. With 3.5% unemployment, and federal spending is growing at 15% when almost 30% of your economy is growing 15%. Hey, guess what? That's 4.5 points of GDP right there, right? 15% times 30% is 4.5 points. So great. So higher for longer? Okay, let's do higher for longer. Let's go to 6. Now you're right now. The 4.5, or excuse me, the rates where they are is 5 on 33 trillion in debt. Pro forma, that 33 trillion times 5%, it's 1.65 trillion. You have $1.65 trillion of Treasury payment interest stimmies being handed out globally and abroad into an economy where the private sector, ISM services, housing, is shrinking. We know this playbook. We saw this playbook in 2021 and 2022. What happens when you hand out trillions of dollars when the private sector supply chains are shrinking on a lag? Big time inflation. Growth and inflation. Okay, guess what we're doing? We're just doing like a slightly modified version of what we did in 2020 and 21, except we're calling it interest expense. We're calling it higher for longer. So, like, the question of is it higher growth or is it higher inflation expectations? Yes. But it's that second derivative that people don't understand yet, which is, oh my God, it's the Fed that's doing that. And the higher they go, the worse they're going to make it. And there's no brakes on this thing. And when people realize that, oh my God, like that. And that's why I say I think it's going to get very disorderly in a very short period of time. Because like everybody there, the TLT, the long US Treasury, long-term Treasury, is a dogmatic position. People love that trade, and they are sure they're right and they're wrong. in my
Yep,
opinion.
and they have a back test chart of every time that ISM has declined, TLT does well. The long bond rallies and yields go down, and it's not working. I'm right there with you. It's not working.
It's right. It's not working, and they're doubling down. They're digging in. They're not saying, under normal circumstance, they say, "All right, I'm wrong," and move on, and they're not, from what I can tell. And like I said, it's you always want to know where who's on the other side of your trade. And I saw someone comment something on the other day on Twitter where they're like, hedge funds are short, like the most short treasuries they've been
Yeah.
like ever. And I'm like, oh my god, like really? That's oh my god, because literally there's been we've highlighted article after article for our clients. It's been written about for the last month. We remember it from 2019. That's one half of a trade. The
Yep.
hedge funds aren't short those futures. That's part of the relative value trade.
Yep.
And it's going against them. And at some point, like this group of investors who, Joseph Wong has he's brilliant, right? He had a great tweet on Friday. He goes, remember, the pain trade is higher. Back in late May, he said they're starting to put the relative value trade on. One of the biggest marginal investors, buyers of Treasury, of cash treasuries, not the futures, the cash treasuries, are hedge funds. And it's going against these guys. And these guys are they have monthly mandates, right? So if a trade goes against them, they are not dogmatic. It's like, it's against us, we're out.
Mm-hmm. And yeah, so folks are saying, look how short treasuries the hedge fund community is. They're short treasury futures against being long cash
treasuries.
So they're harvesting that little, minuscule spread. Explain to me how this is a bad thing, because I talk to people all the time who say higher for longer isn't realistic, but they say it for a different reason than you. They say because the economy can't handle 4%, 5%, 6% rates, and that it's going to throw the economy into a slowdown. What you're saying is actually that higher interest rates are stimulative and actually they stimulate growth. That sounds to me like a good thing. You said there are no brakes on that thing. Don't we want the economy to be vroom vroom, at 120 miles an hour? What can go wrong? This sounds like a good thing.
It's a good thing if you're not long bonds, and it's a good thing if the US federal debt is not what it is and they can finance any rate, and they can't. There's a rate at which it becomes so mathematically obvious that even the staunchest, I have to be kind here, analysts support that there's not a fiscal problem will start to go, guys, there's a fiscal problem. And I would argue we passed that point about 3 weeks ago when you had like the Washington consensus in the Washington Post going, hey, how come the deficits are so big with unemployment so low? That's really weird. We've never seen this before. So if you have rates go up, it's on a lag. It's basically an interest payment stimmy. So the government's going to spend. Okay, fine. That's going to drive growth. That's going to drive employment. Yes. The challenge is that the private sector that you need in theory to finance those deficits will be shrinking. It's a classic crowding out problem. I'll use an extreme because it's just easy math. Let's say the Fed goes higher for longer, takes rates to, 10%. I don't think they're going to do that. It's just easier math than 7. So let's just do 10. Okay, so you're going to have 3.3 trillion in pro forma interest expense, 10% times 33 trillion. That is about 12% of GDP, right? So 26 trillion GDP, 3.3 trillion on top of that. Okay, so roughly 12% of GDP stimulus. In the meantime, all of the banks' holdings of treasuries are going to be wildly upside down. The housing market is going to be really tanking. Anything interest rate is going to be tanking, interest rate sensitive. So your government revenues are going to be falling dramatically. And as a reminder, we're at, we've seen revenues down 20%. It's down more like 7 on a trailing 12-month basis now. And they should get a little bit better actually in the coming months. But your revenues are going to collapse at 10% because we're a highly interest rate sensitive economy. We've financialized over the last 4 years. So now you're going to have the government running 3.3 trillion in interest, a trillion in defense, 3.1 trillion in entitlements. So that's 6.4 plus a trillion is 7.4 trillion in outlays just in the big three. Receipts fell from 4.8 trillion to 4.2 trillion. Just with what the Fed just did. We haven't even really caught up on interest yet. So say that number goes down another 20% to call it 3.3 trillion, which is probably conservative.
What's 3.3 trillion? The receipts?
Receipts. So you're going to be looking at what I say, 7.4 over 3.3. You're going to have a $4.1 trillion deficit. Okay. $4.1 trillion deficit is just short of $350 billion a month net you have to place. Plus roll, which Jamie Dimon said next year over the next 12 months is $5 trillion in roll that you need. Okay, now the dollar is going to be rising like crazy in that because you're going to be squeezing out the global dollar markets. Well, foreigners have $7.5 trillion in treasuries they can sell, including $3.8 trillion at the central bank level. So you're going to add on a net supply basis to that $4.1 trillion deficit plus $5 trillion roll plus up to 3.8 trillion as these nations sell to defend their currencies. And people say, well, that's a position of weakness. They're selling to defend their currencies. Again, who cares? They're selling. All I care about is what's it do for rates in the bond. They're selling, and they will sell aggressively. And so that's also going to take receipts down as it puts more upward. So what you can see is, and oh, by the way, the Fed's supposedly going to be selling $1 trillion too still in QT. Of course, they won't be in that case, but this is why I say I don't get the sense people understand there's no brakes on this thing right now. Like as soon as the hedge funds go the other way, and they will eventually, there's no brakes. There's no brakes. The Fed are the brakes. And people say, well, they can buy it all. I'm like, yeah, they can. And that'll have implications for gold, Bitcoin, oil, dollar. And they're going to have to buy it all with oil at 95, 100.
So you said the hedge funds go the other way. Now they're long the futures and short the cash, or are they taking a directional position in U.S.?
I'm just saying they have to, if they're the biggest marginal buyer, one of the biggest marginal buyers of treasuries, to take that position off, they have to unwind it at some point, whether because they've made money or because they're getting stopped out.
Right.
They are not, they're not buying for any, they're not like central banks who can like buy for political reasons. They don't have to mark the market. They don't have to explain to their investors why they just got carried out on a trade. It doesn't matter, right? The Fed's lost, what have they lost? $1 trillion on their bond portfolio, and they're burning 300-400 billion a year cash losses. Like they don't have to explain it to anybody. They don't have to explain it to anybody. Investors, hedge funds, they have to explain it like monthly. And if they start losing too much money, they just get taken out of their seat, replaced. So like that, they're not going to stay for a trade that goes against them.
So you said, to make it simple math, 10% rates all across the curve, and then I think you multiplied that just by the amount of debt, roughly 30 trillion. You can give us the good numbers, but what about that? All of the U.S. debt is financed over a term of 1 day to 30 years, and so much of that is fixed rate. So the 10-year, if they borrowed at 1% and then interest rates go to 10%, that interest expense stays flat. It's only when it has to be refinanced when interest rates go up. So how have you seen real financing costs go up relative to that assumption that of just multiplying the debt by the interest rates? And then also, is there perhaps a benefit of if everyone in the world, banks, the Federal Reserve, other central banks, bought a voluminous amount of treasuries when yields were at 1% or 1.5% in 2020, and they bought that at par, $100, and now that's at $70? Is that not in some way some sort of gain to the government that some way they convinced everyone in the world to buy their debt at too high a price, too low a yield?
When Jamie Dimon says they need to roll $5 trillion in the next 12 months, that's what is that? It's 20% of the debt in roll right off. I want to say over the next 2 years, they've got to roll a little over half of it. Right. So, and that leads to a question of, hey, with rates at basically zero, why didn't they term it all out? And there's two possible answers to that. A, they're galactically stupid, or B, they can't. In other words, and that's the dirty little secret that I think nobody wants to talk about, but I'm from Cleveland, so I'm not couth enough to not say it. And the answer is the deepest, most liquid market in the world ain't very deep and liquid, and certainly not deep and liquid enough at the long end to place the deficits and the size that the federal government's throwing them off. And that's, if I'd have said that 5 years ago, that would have been highly inflammatory and controversial. And now it's not at all. Like if you talk to someone, like you talk to people in senior seats, it's very obvious that's the reason why they didn't term it out. He's just not talked about in polite company. But like I said, I'm from Cleveland. So as far as the second answer, is it a gain for the government? Yeah, it is. There's a great quote from William McChesney Martin, the Fed governor that everybody loves because he was the guy before Burns.
Mhm.
The quote is when McChesney Martin was the assistant secretary of the Treasury. I believe he said it in 1951, right after World War II, when our debt to GDP looked a lot like it looks now, or it did certainly 5 years prior to 1951. It is the lead quote on a white paper from Carmen Reinhardt and Belen Zabrancia from 2016, I think, called The Liquidation of Government Debt, which ought to give you a pretty good idea of liquidation. We're watching the government debt get liquidated as we speak. The quote is regarding the 2 3/4 non-convertible issue of 30-year treasuries. We want to meet these concerns head on about whether it is a trick issue. It is. And it's a trick issue because guess what they did? They turned it out and you were not allowed to convert it, I guess. And basically the real value of those 30-year bonds in 1951 went to zero by 1980. In terms of what they bought, oil was $2 in 1951.
Because inflation went up and because interest went up, so it was worth less.
It just, yeah, the real and the nominal value collapsed too, for sure. But the real, but my point is like you get to do that once. You can snooker the world once, and then you get what we're starting to see, which is I tweeted about it yesterday. I wrote about it last week. David Costa has this great chart showing that downside volatility in gold for the first time in 45 years is less than long-term treasuries. Markets are telling you gold is less risky than treasuries now. They pulled it off once. They snookered them once. Oh my God. But you didn't fix anything. If you're going to do that, you need to get GDP down. Like that's, 45 to 51, US debt to GDP went from 110 to 50%. You snookered people. Real rates went to negative 13. It was what it was. There was a different time and an understanding of why that had to happen, whatever. They've snookered people, and debt to GDP is exactly where it was when they started snookering people. And so now you still have to place all this, right? $2 trillion, assuming no recession, we have to place $2 trillion next year. And this is Jamie Dimon telling the world this 2 weeks ago. And also we need to roll $5 trillion next year. Now what are you going to do?
If the playbooks of the last time debt to GDP was this high was 1945, it was over 150%. What was that snookering? What happened? Why can't the U.S. government snooker bondholders around the world again? But first, tell us what you mean by snookered.
It's just negative real rates. And it's been my playbook the whole time. We wrote, so what happened then was, 10-year treasuries were long-term treasuries is how they have it historically. We're at 2% in November 1941. And Japan bombed Pearl Harbor, and overnight the 10-year treasury, long-term treasury went from 2 to 2.5, and the Fed came in and capped it at 2.5. They kept the 10-year at 2.5. They kept the short end, I want to say at 3/8 or 3/4, I don't remember. So there was a slightly positive yield curve, and they kept it flat from 42 to 1951 for 10 years. And as a bondholder, you got paid every dime you were owed, and you got killed on a real basis. At worst in the United States, real rates were negative 13%. Post-war, at worst, real rates in Japan were negative 60%. In parts of Europe and Australia, they were negative 30 to negative 40% at worst. You lost a ton of money on a real basis. Thank you for your donation to the war effort. And by 1951, debt to GDP was down to 50%. And then they were able to separate Fed and Treasury, go back to independent Fed policy, and you can start to manage monetary policy separate from fiscal policy again, because you can do that without blowing up the system. Fast forward to 2020 and early 2021, I wrote a report for clients that said they need to run the same playbook. Go back to late 2020, Jason Furman, Ben Bernanke, Larry Summers, Olivier Blanchard, Ken Rogoff, all were part of a discussion of a white paper by Furman and Summers saying we need to run the same playbook. We need to basically inflate this away. And what I wrote and analyzed in a simple analysis was that the last time the Fed was able to manage policy, raise rates without blowing something up was when debt to GDP was 70 to 80%. I said, so we need to go from 120 to 70 to 80%. And the simple math in terms of negative rates needed to drive that were somewhere between negative 10 and negative 20% real rates in the United States for 3 to 5 years. That's it. And at first in 21, it looked like they were doing that. It's like, okay. And then politics got involved. In early 22, the Russian war got involved. The election got involved. And all of a sudden the Fed said, uh-oh, we need to fight inflation. Okay. And at first I didn't believe they were going to do it because like, well, they have this playbook. They laid the playbook out pre-20, right? The BlackRock white paper in August of 2019 is like, we're just going to inflate this away. We're going to go direct, we're going to fiscal, and the Fed's going to buy it. And then it happened, and then they went direct, and they did fiscal, and the Fed started buying it. In 21, they did it, and Summers and all these guys blessed it. And then so at first in 22, I was like, they're not going to reverse it. If they reverse this is going to be a disaster. And then it was like, oh my God, they're reversing it. So it was like, in mid-April 2022, it was like, what they're doing, the only thing this is good for is a dollar. Like everything else is going to go down. Treasuries, stocks, everything is going to go down. Then they bought themselves time last October when they weakened the dollar by about 15%.
How did they do that?
Primarily Yellen running down the TGA massively, more than offset QT. The point here is what's the playbook they need to do is the Fed needed to let inflation continue to run hot in 22. And 23. And had they done so, we'd probably be getting to a point where debt to GDP was 70 to 80% by now, and they would be able to start hiking. And, in other words, that said that the markdown of bonds from 100 to 70 at the long end, they needed to be 100 to 20. They need to be 100 to 10. Like they didn't do enough because debt to GDP didn't come down. So they weren't aggressive enough. And so now, here we are, and they haven't made any progress, and they've already kind of run the playbook of like, okay, mark the debt down. Like, okay, you want to mark it down again? You can't because you didn't get debt to GDP down enough. If debt to GDP had gone down to 70, then you still have the option of letting rates go from 5 to 7 to 8. It doesn't bankrupt you. With debt to GDP still at 120 and deficits at 8.5, you let rates go from 5 to 7 to 10, you're done. It's over. You go into a feedback loop. And I think we're starting to see symptoms of that feedback loop. I think the fact that gold has less downside volatility than treasuries for the first time in 45 years is a symptom that markets are starting to understand the U.S. is about to go into a feedback loop. I think the fact that real rates have risen the most in 40 years and gold hasn't gone down is another symptom of markets beginning to understand the U.S. is that close to going into a feedback loop. You say, okay, well, what happens then? They told you at Jackson Hole, and no one wanted to talk about it. Daryl Duffy wrote a white paper, and Jeremy Stein commented on it, and they said the Fed may need to tell markets and differentiate between market functioning purchases of treasuries and monetary policy purchases of treasuries. Wait, what? And like to me, that was the biggest takeaway from Jackson Hole. There was a whole bunch of ink spilled. Only a couple people picked it up. But like they know they have a problem and they're hoping this doesn't go against them. They're hoping, but it's got like the math is the math. Hope's not a strategy. They're going to have to do it. And I think they know it, which is why they're talking about it at such an important meeting, Jackson Hole. And we're rapidly heading toward that moment. I'm watching the gears spinning. And unless the dollar gets lowered meaningfully or unless oil gets lowered meaningfully, this is likely going to happen.
So interest rates raise the fiscal expense, and they can create more debt to fund that expense, so that increases debt to GDP. But wouldn't higher interest rates also cause GDP to go down, and nominal GDP, particularly, inflation denominated GDP? And it's because I think the way Jay Powell thinks about this is if interest rates go back to zero, that is not going to help the U.S. debt problem because inflation is going to run super hot, and the government's probably going to borrow even more. And not saying that Powell is Volcker, but Volcker was very anti-debt, and unlike today's Federal Reserve, he was quite open about his desire to shrink the U.S. Deficit. In other words, high interest rates discourage government borrowing because if you want to borrow at 20% to fund a government project, it's not going to work out very long.
Powell's no Volcker. He can't be Volcker. Deficit when Volcker did what he did was 2% of GDP. It's 8 on a trailing 12-month basis. Debt to GDP was 25 to 30%. There was literally, Volcker couldn't hike rates enough to bankrupt the government. Powell can. And it ain't that far from here. And when I say bankrupt, it's either the Fed comes in and caps it or it goes into a debt spiral. Powell seems to want to mandate government policy. In other words, he wants to make government borrowing more expensive. Maybe he's doing that. But if that's the case, he needs to pick up a history book, because I would challenge him to find a country with a purely fiat currency that it could print where the government shut down, where the government shrank itself voluntarily. He'd be very hard pressed to find an example. So what's he actually doing? He's actually increasing the deficit. Because when you look at what makes up the deficit, it's entitlements, 3.1 trillion, broadly defined. That's health and human services and Social Security. And so that's 3.1 trillion on 4.2 trillion in receipts. That's almost 70% of receipts just on entitlements. And that's just it. To be clear, that's just an interest expense. That's just the interest expense on the off-balance sheet liabilities. Let's go to 100 trillion or whatever the hell they are. Let's just be clear and call that what it is. Defense. So is Powell, people say, well, the bond market's doing the Fed's job for it. Yeah, it's doing Putin's too. So is Powell saying we should shut down defense because he's raising rates? That's what he's doing. Is that the right thing to do for America? I don't know. Who elected him? Nobody. Is it going to happen? There's not a chance. There is zero chance he's going to shrink defense spending by raising rates. All he's going to do is make the deficit bigger. So bigger deficits with 3.5% unemployment. Now, can he shrink the private sector output? Sure he can. But if he's making deficits bigger while shrinking private sector output, he's going to shrink receipts. He's going to make deficits even bigger from two angles. He's going to send interest up and he's going to send receipts down, which is going to send issuance up and the dollar up, which is going to send more net supply up as foreigners sell to defend their currencies, which is send rates up, which is going to send receipts on the private side down, which is going to send risk. People say he hasn't broken anything yet. He has broken it, and it's about to be mark to market. We're watching it in real time. He's broken two things. He's on the process of breaking the Treasury market, and he's already broken the U.S. energy market, because that's the other thing.
How has he broken the U.S. energy market?
Oh, because shale is interest rate sensitive. He and Biden have combined. The SPR releases and Fed rate hikes. Last week, it just came out. The Permian is rolling over. Permian production is negative in the EIA data in October. So let's get to it. We want to fight Putin. We're in a war. Okay. If we're really in a war, why isn't he buying all the debt? Why is he raising rates? And why is he hurting oil? Those are literally the opposite of the two things that you do in war. So either we're not in a war or he's not acting in the interests of the United States. I don't know which it is. In World War II, in Vietnam, the Fed held rates below and we maximized oil production. I'm not sure if he's doing this on purpose or if he's just acting dogmatically to raise rates. But in the end, again, it doesn't matter. This is what's happening.
So let's say in a year, September 2024, the Federal Reserve has maintained interest rates at 5.5% and is still doing quantitative tightening. What does that world look like? The unemployment rate, stock market, the long-term bond, the dollar, gold. Tell me what that world looks like.
I don't think we make it September 2024 before something really breaks in that world. Um, he would need, for him to stop inflation, if he wants to continue, if he wants to run this thing out, if he really wants to be Volcker, what he needs to do is when the 10-year spikes to 6, stand aside. And when the US banking system starts to fail, stand aside. And when people start saying to him, oh, I'm an unsecured depositor, my money's going to go away, stand aside. And when a Treasury auction has a problem at that rate because of the net supply dynamics, because 6% implies a much higher dollar, lots of foreign selling, stand aside. And when oil's at 110 because it's 6% rates, there's not, stand aside. And the reality is he's had that chance to stand aside and he didn't. He did BTFP. He, they just paused. They can't, he had the chance back in March to do all that and he didn't. So to me, it's all about when does this supply demand dynamic create disorderly upside in yields where he comes in and does market function purchases of treasuries or for market resilience of the treasury market, right? And we saw a little hint of that last week, in my opinion. We had that treasury official come out and say, no, we're going to do treasury buybacks for the first time in 20 years for market resilience, to build and boost the resilience of the US treasury market, which is the deepest, most liquid market in the world, trademark 1985 USA. If it's so deep and liquid, why do you need to do buybacks to boost its resilience? It's sort of like a few good men. If you gave the order that Santiago wasn't to be touched and your orders were always followed, why was he in danger? Why did he have to be transferred off the base? Same thing here. If the market is so resilient, why do they need to do buybacks? Why do they need to even discuss market function purchases at Jackson Hole versus and differentiate them from monetary policy purchases? The answer is, yeah, he ordered the code red. So I don't. What does that world look like if the world's still there? If he stands aside, it's a new Great Depression. He's not going to stand aside, and I think it happens way before then that he doesn't stand aside in terms of what rates do.
But wait, what's going to break? So, as you said, the Federal Reserve initiated the Bank Term Funding Program, which allows my audience is very familiar with this as you are, allowed banks to borrow against their fallen assets at par. So that's a big help to the Bank Term Funding Program. But when you say things are going to break, please be specific. What do you mean?
The oil market did. The U.S. shale business is breaking. And this to me is one of these really interesting things. Is everyone is fighting the last war, the Fed included. Shale supported the dollar. Shale supported the bond market. Shale kept inflation low. 90% of global oil production growth over the last 10 years has come from U.S. shale. U.S. shale is now starting to roll over thanks to the SPR releases and the Fed rate hikes. People say, oof, if oil keeps going up, the Fed's going to have to keep raising rates. Shale just rolled over. Permian production is set to decline in October, per the EIA last week. So 90% of global production growth over the last 10 years is now shrinking. So how is oil going to go down if marginal supplies are falling? Oh, well, they can shrink the economy, but they're not shrinking the economy. The U.S. government, the GDP is doing great. So you're going, the feedback loop between higher oil, which increases inflation expectations, which forces more treasury selling from foreigners because they need energy more than they need dollars. They need energy more than they need treasuries, no matter what anybody says. It accelerates this feedback loop of net treasury supply. Rates up, interest expense up, more government spending, deficits up, private sector down, private sector supplies down. It's hard to overstate how toxic this is. It's plain as day. It is so clear. We're just now going to start to really watch it.
So do you think that everything being equal, which it never is, but everything being equal, interest rates higher interest rates cause the price of oil to go up, not down?
Paradoxically, up to unless you're willing to like really crash the global economy. Yeah. Yeah, because then this is another factor that, like, if I was trading bonds and rates, I would be intimately familiar with U.S. shale. And the reality is most people that trade bonds and rates that I've encountered, like, they say, well, we're now one of the biggest producers of oil globally, and that's that. And they don't understand exactly that it's been 90% of global production growth over the last 10 years. They don't understand that U.S. shale is the highest marginal cost oil or close to it in the world. They don't understand that once you stop drilling, there's a treadmill effect. So basically, you have to keep growing production at very large rates. Otherwise, production falls. They don't understand that the decline rate on the legacy production last month from the big four shale basins, the Permian, the Bakken, the Eagle Ford, and the Niobrara, were 6.6% per month last month. It's not a linear rate of decline. The rate of decline declines over time. But again, they don't understand that. They don't understand that if you hurt shale, you see the oil market back to Saudi and Russia. They don't understand what Russia and Saudi. Now, if we have hurt our own ability, if Powell with rate hikes and Biden with SPR releases has hurt our ability to keep oil prices down, what do we think Russia's going to do with oil this winter? Well, we don't have to guess anymore because they just temporarily suspended exports of diesel. You know, there's the rate silo and there's the energy silo. And like the energy guys I'm talking to are like, oh my God. And like the rates guys are like, oh, don't worry, like inflation's going to come down. They don't understand the pro-cyclical nature of what rates are going to do to U.S. oil production and what that implies for oil inflation, for geopolitics, etc. And that's, you know, for the last 3-4 months, that's been the oil guys' gain and the bond guys' loss. And I think it's going to continue to be. And at some point, the bond guys are going to go, oh my God. And then things are going to get real interesting because once they realize that the U.S. has put a bullet in U.S. shale production growth. So now Russia and Saudi control the oil market again. Why do I own TLT? You know, it basically limits your case to like they're going to literally fly the plane into the ground. They're going to crash the system. They're going to shut down. Like, can you get oil down? Yes. Shut down the economy like COVID. You get oil down. It goes negative. Failing that, but oh, by the way, at the bottom of COVID in March of 2020, Treasury started selling off. Remember, Treasury market crashed. So, you know, owning TLT is like trying to capture increasingly. It's like this shrinking trade where it's like, okay, if they crash the economy enough, like they did in COVID, that oil really goes down and there's this short-term scramble for liquidity. Well, yields will fall as markets as stocks go into bonds. And so I want to capture it for the moment from here to like right before it crashes and yields start going back up again. And then before the Fed and if you can trade that, hey, great. But I don't get the sense I know I can't trade that. I get the sense a lot of people don't understand the game they're playing as it relates to that long bond trade.
What do you think happens with oil? Because we're close to $100 on Brent. Do you think that there is a recessionary effect when oil gets quite high? As oil went to $120 in June. That's when you had we're not calling it a recession. I don't think it was a recession, but a mid-cycle slowdown. And then oil starts going down. What do you have happen? Suddenly we were started hearing about a resilient economy. So, I mean, is there a limiting factor where if oil goes to $120, the world will enter a recession, or $150 because of demand destruction?
There's initial derivative effects and then there's second derivative effects, right? So if oil goes to 120 or 150, yes, it's going to slow the private sector dramatically. It's going to increase U.S. shale production in theory, right? So ISM is going to go up in the U.S. And so the Fed's going to need to raise rates even more, right? ISM all of a sudden is going to print 52, 53 from 48. And it's going to be all oil drilling related and supply chain related. And all of a sudden it's going, oh my God, they got to raise rates even more. That's number one. So possible, but not good for bonds. Number one. Number two, oil at 120, 150. I go back to the initial point I made about unless you get the dollar down and you get oil down, the pain in bonds is going to continue. Foreigners own 7.5 trillion in US treasuries total. So their central banks own 3.8 trillion of that. And they need oil. And so if oil's at 120, it's not like they buy 30% less oil and let their people starve and ride bikes. They buy the oil and they sell the treasuries. So if oil goes to 120, 150, that net rate of treasury selling, effective selling we talked about before, accelerates. So you're going to get, if oil goes 120, 150, TLT, when I jumped on here this morning, is at 89. You'd be a friggin' 75. And again, some point between here and there, I think the Fed, and by the way, it could do that in like 3 weeks, 4 weeks. So would that hurt oil? Yes, if the Fed is willing to stand aside and let Treasury markets dysfunction. In my opinion, there is zero chance the Fed is going to stand aside as TLT goes from 90 to 75 in a few weeks.
And what does Treasury market dysfunction mean to you? Is it about an absolute level, TLT at 75? Let's just say the 30-year, the 10-year at 5.5%, or is it about a series of asynchronous movements? If we gradually move to 10-year at 6%, but it's not at all volatile, is that a Treasury market breaking? What does it mean to you?
To me, it's about the liquidity and the asynchronous of the movements. And to be clear, we're talking about, whatever, it's 33 trillion out, and I think it's a 24 trillion size is what they quote, maybe 25, whatever it is. Anything that big is going to create asynchronous movement. Anything that big relative to balance sheet capacity. Like who has the balance sheet capacity to deal with those kind of losses? You're talking about a $25 trillion market. If it drops 5%, someone has lost over $1 trillion. Someone's gained $1 trillion, someone's lost $1 trillion. Depending on who's lost that trillion and how that's accounted for. Like that requires you to sell something else. And that's why, and that something else will force the dollar up, which will force more selling. The feedback loops are multiple and generally all in one direction, because sort of every lever has been pulled to sort of hold this thing up and support it as long as it has been held up.
When I proposed September 2024, you said the wheels come off this thing earlier. What do you think in terms of timeline, and what are things you will be on the lookout for if when the 10-year hits 5%, this will happen, or when gold hits this level, this will happen?
It's a little bit like the whole, you may be too young to remember this, and I'm not jacking you on that, but there was an art exhibition in Cincinnati back in like 1990 of Robert Mapplethorpe art, and some federal judge was like, I don't have the definition for profane, but I know it when I see it. And it's a little bit of the same kind of thing, which is, let's see what the Treasury Move Index does. That's been relatively tame so far. Let's see what the banks do. Let's see what Treasury markets do. Let's see what the dollar does. Let's see what oil does. Let's see what geopolitics do. Right? These things are so interconnected. Where 2 weeks ago, we saw, Sky News in England reporting on reporting proudly that British missiles were used to hit Russian ships at a naval base in I think it was in Sevastopol in Crimea. And you kind of go, hey, great. What do you think the Russians are going to do? You actually think they're just going to sit there and do that? Or might they weaponize oil more? And if they weaponize oil more, what does that mean for rates?
Then how do they fund their war effort?
China will buy it.
But that's the fungible market. If China's buying it, then oil traders can buy it from China or buy it from India.
Absolutely.
Yeah.
Absolutely. And exactly, right? Oil, it's a fungible market, but it's also an elastic market, right? Russia can cut production by 3%, and price goes up a hell of a lot more than 3%. And, they can do what they just announced 2 weeks ago, which is, hey, starting in January, we're going to sell gas to China at half the price of the EU. Okay. How do you compete with gas twice as much as your competitor? And the answer is you don't. You go out of business slowly. And so, like, my point here as it relates to the original question, which is with what am I watching? I'm sort of watching like all of this, right? What are the geopolitics? What does the oil market do? The two key levers: dollar, oil. We'll simplify that. Unless the dollar goes down a lot, or unless oil goes down a lot, the beatings in treasury markets and gilt markets and bond markets and Italian bond market, they will continue, and they will continue, and they will continue until we get a repo rate September 2019 spike, except in Western sovereign bond markets. And then everyone's going to go, I don't see how come nobody saw this had happened? How nobody knew the Fed had already broken something? And I'm telling you, they've already broken something. So we can reference back there how no one could have seen it. I saw it. It is so obvious to me.
When did the Fed break something?
When they decided to tighten instead of let inflation rise.
But what was the thing that broke?
What was the thing that broke? Mm-hmm. The U.S. fiscal position. The U.S. fiscal position and U.S. shale. U.S. tax receipts trailing 12 months as of a month and a half ago down 20%. You don't get to have receipts fall like that when you have debt to GDP of 120%.
Why do they fall 20%?
Stock market was down, drove receipts down drives issuance up. Mm-hmm. And you already have a supply-demand problem. You don't get to increase supply into what is already a tenuous supply-demand problem. Like, there's only so many bears you can poke, right? Like, you can't reduce issuance or increase issuance because you knock stocks down, increase issuance because you raised rates, increase issuance because the dollar is strengthening based on what you've done, increase issuance because you've hurt your own oil business, which is hurting receipts, which is increasing in oil inflation, which is increasing rates. Increase issuance because you're picking a fight with the biggest energy supplier in the world, and with your former biggest creditor, and the world's factory. You don't get to do that. You have to pick and choose. And so, it's when the Fed did not let inflation run hot for as long as they needed to, that started it. Now we're just watching it play out.
But so when you said something broke, I feel like, raising interest rates will mechanically increase interest expense. But so nothing outside the fiscal position has broken. You're just referring to the fiscal position.
I would argue the banks have broken.
Mm-hmm.
I mean, the fact that they need to do BTFP. Look, that wasn't a banking problem. That was a treasury market problem. They were upside down. Again, if Powell wanted to be Volcker, the answer was very simple. Stand aside. Banks saying, we're upside down. Okay, sell your treasuries. The banks own four of U.S. commercial banks. Holdings of treasuries have gone from, I don't know, at the peak, I want to say they were $4.5 trillion, give or take. They're down a bit. Let them sell them all. Sell them all. They had to, they would have taken major losses. So, no, they don't care that they would have taken losses. They didn't want them selling it because it would have created treasury market dysfunction. So the Fed had to get involved. They had to do the BTFP. BTFP is just yield curve control for banks. They're taking underwater bonds and buying them at par. If Powell wanted to be Volcker, stand aside. Why didn't he stand aside? Why did he bail out unsecured depositors?
I think because the only way to fix the banking system was door number one is stop quantitative tightening and lower interest rates. And door number two is keep quantitative tightening and keep interest rates high, keep raising interest rates and do BTFP. I think door number two was the tighter monetary policy door.
It was the one that saved the banks, but it was like bank loans are up again. They're rising. So how, again, if he wanted to be Volcker, he needed to stand aside. He did. He picked and chose. You don't get to pick and choose. Like Volcker just kill them all, let God sort them out.
Yeah, but I'd say Powell, it was the tightest thing you could do. I don't think he could have not done BTFP and continued to tighten monetary policy. So my next question is: you're not worried about a recession. You're not at all. Sounds like you're not at all worried about higher interest rates causing a recession via the normal channel of banks restricting credit and unemployment. You're not worried about that.
No, the banks aren't the ones with the problem. Well, let me back up. The traditional way of doing it is banks restrict credit to people,
Yeah.
right? So right now, the banks, their rates went up. My rate didn't go up. I got a 30-year mortgage at 2.9,
Nice.
right? So, and I'm not the only guy. So
No.
if I'm making 200 basis points between what my cash on the bank and my mortgage, there's a bank somewhere bleeding 200 basis points.
Yep.
And in reality, it's probably the government, right? They probably own the mortgage back, and the Fed's bleeding. Is that really restrictive? If I'm getting a 200 basis point a year debt jubilee, that's not restrictive. It's great. I'm getting a free house. Thank you, Fed. And so are a lot of other people. And so it ties back to that point about there's a lot of things with this cycle that are upside down in terms of, is it restrictive? It's not restrictive for the public sector. The deficits are the deficits. There is no world in which running an 8%, 8.5% deficit, 3.5% unemployment is deflationary. It just isn't. Like it's not, and it's not going to be. And yes, you will have deflationary pockets on the private side. That was just netting against for a bit. Ultimately, as that happens, you're going to end up with less supply and more money. That's super inflationary. They've already, that's what I mean. They've already broken it. They did the wrong thing. They needed to let inflate. Once you get the GDP to 120%, there's no well, maybe we can. No, negative real rates for 5 years, double digits, come back. That's it. Or you devalue the currency all at once. That's it. 30, 40, 50% overnight. That's it. Those are your choices. Otherwise, you try to pretend things are still normal. I can be Volcker. No, it's not how it works. And they did a good job pretending in 2022. They tried. It failed. The gilt market broke first. The U.S. banks broke. Yes. Is China under strain? Yes. Is China broken? No. China did not break before the banks. No. China did not break before the gilt market. The Treasury market was very, was dysfunctioning right alongside the gilt market, just a little, a few steps behind when Yellen came in and weakened the dollar, taking down TGA so aggressively.
What about inflation going to 15%? Then real interest rates are negative.
That would be great.
Yeah.
I mean, that's what has to happen. Will it be great? No, I should rephrase that. If they want to get out of this, that's kind of what has to happen. You got inflation 15, Fed pens it at 3, and you know what? The problem is you can't do that without some sort of capital controls, right? The Fed's going to have to buy the whole bond market because nobody is going to hold a bond at 3 when inflation's 15.
Well, the clearing price will just be 9%, and that's fine. I mean, interest rates can, the bonds can go to 9%. They can go to 10%, 11%. What is so? That's what I'm trying to tease at this conversation. What is so unstable about, a very upward sloping yield curve? Fed is at 5.5%, and the long end sells off to 7%, 8%.
That's totally unstable because, okay, so 5.5 at the front end, 9 at the long end. The housing market has tanked across the country, in my opinion. Let's set aside all the corporate refinancings that are going to have to take place. And that probably hurts things too. The equity market is probably quite a bit lower. So between the housing market and the equity market, quite a bit lower. You are going to have tax receipts quite a bit lower. So your issuance is going to be quite a bit higher. So now you're going to need more issuance. 9% long end means the dollar is quite a bit higher. That means that 3.8 trillion that foreign central banks have is quite a bit lower. So
isn't that good for the U.S.?
No. Well, good for the U.S. how?
In terms of its fiscal position.
No, it's
because
terrible for the U.S.
because it's well, foreigners' holdings have declined in value. That's good.
That's terrible because they're selling. Well, how is that good for the United States? Whether it's good or bad is irrelevant. Here's what it is. Like is what it is. Foreigners will be selling 3.8 trillion. Go back to that math. Okay, let's say 5% front end, 9% long end. U.S. Tax receipts fall another 20% from 4.2 to whatever 3.3. You're going to be running much bigger deficits. So remember the numbers I just gave you before in terms of the spending. What did I say? 7.4 trillion between interest, entitlements, and defense against 3.3 trillion in receipts. So now you're at 4.1 trillion in deficits you need to finance. Okay. Plus you need 5 trillion in roll next year per Jamie Dimon. Plus the dollar's gonna be much higher. Foreigners are gonna be selling. Yes. Now, so is it good or is it bad? Is it putting them in pain? Sure, it's putting them in pain. But it's like shooting yourself, in the jugular and saying, ha ha ha, I'm gonna bleed out slower than you are. They have 3.8 trillion at the central bank, 7.5 trillion overall. Let's say they sell that 3.8 trillion in a year. Let's say they sell it at a $1.9 trillion a year rate.
And the reason they'll be selling is to defend their currency.
Correct. Mm-hmm. So now you've got, what did I say? 7.4 minus 3.3 in receipts. So 4.1 net plus 5 trillion in roll plus 1.9. So you're now going to have just 4.1 plus 1.9 is 6 trillion in net effective issuance. And you're going to have the Fed selling another 1.2, allegedly. That's probably wouldn't be happening. But okay, so now you're up to 7.3 trillion net effective issuance. That's just over 600 billion a month in net effective issuance. And now you're also going to have 5 trillion in roll. Where's the balance sheet? What's the rating going to be? 9? The rate's not going to be 5.5. Like, there's no balance sheet. So is this good for the U.S.? Yeah. Again, as long as Powell is willing to stand aside and let the free market work. But that implies, that's why I say there's no breaks. You're going to get a nonlinear rise in rates because there isn't a balance sheet at these rates. There just isn't. So now the higher you get a nonlinear rise in rates, guess what? Oops, it's not 7.1. It's 8.1. Oof, it's 9. So there's only one outcome. The Fed's going to have to buy it.
What about banks buying it and using the repo facility, the thing that was set up in 2019, which is the limit? I think is 500 billion, but the limit is essentially unlimited.
Sure, that's just QE. That's all it is.
Okay, but it's the banks owning it rather than the Fed owning it.
Yeah, just like SLR exemptions were the banks rather than the Fed owning it. Like if the Fed gives the banks the money to buy it, if your dad gives you the money to buy a Lamborghini, is it your Lamborghini, your dad's Lamborghini? It's your dad's Lamborghini.
Okay, but that's not that facility already exists, so it's not.
Sure. Oh, I'm not saying. To be clear, I'm not saying there aren't buyers. I'm saying the buyer is it's the classic the dollar or the Treasury market, and the Fed is going to have to come in and in some way, shape, or form. And we've been very clear about this in our writing. Like when I say the Fed, it's dollar liquidity. It can be Treasury with buybacks. It can be SLR exemptions reinstated at the banking level. It can be the standing repo facility. It can be all these things. All those things are just QE. And you'll have purists say, no, it's not QE. And the market's going to be like Tommy Lee Jones in the Fugitive, right? I don't care. They're going to buy gold. And I think that's why gold is not going down. Like the math is so clear. Like the Fed's going to have to buy it in some way, shape, or form, because when you lay out the numbers, there isn't the balance sheet. Like when I lay out that whatever it was, 6 trillion conservative plus 5 trillion roll, by way of comparison, global GDP is, 90 trillion? Growing 3? Okay, that's 2.7 trillion in global GDP growth. The U.S. will need incremental, and that's assuming growth. We're talking about a global recession, so it's actually shrinking. But let's be conservative. 3 trillion in global growth And the US government needs 2x that just in their current financing, net effective, let alone the roll. Like there's not enough balance sheet. Like people aren't taking a step back and going, oh my God. Like, and they say, well, it'll get bought. Well, yeah, it'll get bought. I'm not saying it's not going to get bought. It'll get bought by the Fed or it'll get bought by the private sector at much higher rates. And then we just keep playing this game until the rate gets to a point where the Fed says enough. We're buying it, and it's not going to go higher than here.
But the repo facilities, so that already exists. Do you think that is sufficient? In other words, the Fed can keep rates at 5.5% and keep reducing its balance sheet. They're just making loans to the private sector to buy this collateral, as it occurred in 2019. Because there is a difference. I mean, yeah, if your dad lends money to buy a car, yeah, it's not your car, but you do own the car. You're just your dad. I mean, presumably, there's a nice arrangement there. But like if a bank lends you money to buy a house, the bank doesn't own the house, and the Fed lends.
Oh, sure they do. Oh, absolutely they do. Absolutely they do. It's don't pay them. See how quickly they see how perceived you are.
Yeah, but JP Morgan can pay the Fed back if a 10 years yielding 7% and repo is raised at 5.5%, where short-term interest rates are. JP Morgan, they're good for the money, as are most banks. Like that's a positive. Do we just need positive carry in the yield curve, and then banks can basically do a levered trade with treasuries borrowing from the Fed?
That's what I say about getting the dollar down. That's it. Unless you get the dollar down or oil down, the treasury market's going to keep dysfunction. That will get the dollar down. If they do it in enough liquidity, then that will work. You got to get the dollar down. Like that's what you're saying is they're going to devalue the dollar. Yeah, okay, then sure, that'll work. But you're not going to, that's the other side of this equation. 559. Well, yeah, it'll work if the dollar's at 70, not at 105.
Mm-hmm. What do you see happening to the dollar now? I mean, it's been strengthening for a little bit now.
I think it's going to get, it's the corollary to the, unless they get the dollar down or they get oil down, not even really, the dollar's going to keep going up because they have broken this already. They are in this feedback loop. They don't understand they're in this feedback loop. Maybe they do. I think they do a little bit. I think they're a little nervous.
Yeah, I kind of sensed a little bit of nervousness from Powell in the September meeting that I don't normally sense from him. He used the words "be careful." You've seen the movie Margin Call?
I have, yes.
Yeah. So there's a scene when the boss, played by Stanley Tucci, gives the key, what's it called, the flash drive to the kid, and he says, "Be careful."
I was working on something, but they wouldn't let me finish it. So take a look at it. Be careful.
I kind of felt like that when Powell said "be careful" 7 times. Not that we're predicting some great financial crisis, but you think they are nervous?
If they understand what they're in, I'd be crapping my pants. They are very dangerously close to discrediting themselves with rate hikes, which would be just delicious irony. It would be delicious irony. I do, because again, it's ultimately a fiscal problem. The playbook on these things is so clear. They're so clear. They wrote a white paper about it 7 years ago. There is a very concrete set of steps you have to follow. And they have gone about since 2022 a monetary policy that is based on a set of circumstances that is simply not correct. I wrote a tweet the other day of, from Parks and Recreation, of whatever his name is, throwing the computer in the garbage.
Oh, yeah.
And I said, this is me, the Fed has never raised rates, let alone this fast, with debt to GDP at 120%, trailing 12-month deficits at 8% rising, with the U.S. net international investment position at negative 65% of GDP, and with the U.S. being the biggest marginal high-cost oil producer in the world, responsible for 90% of global production growth. Like that set of circumstances, like you simply couldn't do what they did. It was like I can't. How wrong it was. It was 100% the wrong thing. Now, were they forced into it by politics domestically with inflation? Probably. Were they forced into it a bit geopolitically with what Russia did? Probably a little bit. But again, I don't care. It doesn't matter. They did the wrong thing at the wrong time. And so now we're starting to see, the implications of that. Shale's rolling over. The SPR is drawn down. Tax receipts are down. Deficits are up. debt to GDP hasn't fallen. Like, I would be, if they haven't figured out yet that like they're in serious, I think they're starting to.
And we haven't discussed at all the chance of the U.S. government spending less money. That's not on the table, right?
Oh, this is a little bit like the only thing it saves them is some sort of productivity miracle, right? So they roll out some sort of nuclear, fission, like,
Yeah.
portable reactors. And I hear these things do exist in some form, right? So if they came out and said, hey, instead of giving Zelensky another whatever, we're going to spend, $100 billion and we'll put these things in over the next year. And, people are going to get really cheap electricity and Starlink and okay, maybe you could start, you're going to get a productivity bump, et cetera, et cetera. Failing that, and there's other productivity or productivity and miracles or energy miracles you could have. But failing that, here too, like, I don't think people understand, when you have a severe disease, you don't get to wait too long and then say like, oh, okay, now I'm ready to be healed. Now I'm ready to get serious. No, once you get to a certain point, like, they put you in palliative care, they make you comfortable, and they let you die. And the metaphor for that for the fiscal side is US deficit to GDP is 8.5% almost on a trailing 12-month basis. So let's not take it to flat like we were under Clinton, which was a fluke itself, but let's take it to where we were with Volcker, to 2. That means we need to cut 6.5 points of GDP now. That means GDP is going to fall 6.5% now. Annual GDP in the Great Financial Crisis fell 3 to 4 and nearly collapsed the banking system. Annual GDP in COVID, when we shut the friggin' economy down, fell like 6. You can't do it. Mathematically, the mismatch between when you pick up productivity for getting the government out of the way in 3 to 5 years versus the GDP hit now relative to the leverage in the system, unless they are willing to stand aside and let the banking system collapse, let the US government shut down, lay off the Marine Corps, no, it is not a possibility. And that sets aside all the politics. I'm just saying it's mathematically impossible. I'm not even talking about whether it's politically impossible, which, by the way, it is.
Yeah. So what do you think about the stock market? What do stocks do here in this scenario that you envision? I guess before the pivot and then after the pivot.
So there's 2 ways to think about it. The U.S. is in an Argentina situation. That's what I'm describing.
It is in Argentina.
Absolutely.
Okay.
Yeah. As soon as the Fed tried to tighten rates before they let debt to GDP go down, they had put themselves, they're in fiscal dominance. That's what this is all about. The fact that the Fed hiked rates and we now have interest and entitlements above receipts, that's fiscal dominance. Like, the fiscal's driving the boat.
The fiscal's driving the boat, fiscal dominance, sure. But Argentina, they had a lot of debt denominated in a currency they couldn't print. And no one really wants Argentine pesos. That you can print. The Fed can print. The U.S. dollar. The U.S. government can print dollars. And
they can't print healthcare goods and services. The United States owes its baby boomers $70 trillion in healthcare goods and services and Social Security. Social Security is inflation adjusting, as we're seeing. Number 2, the boomers aren't owed whatever it is, 35, 40 trillion in Medicare in dollars. They're owed hips. They're owed knees, they're owed drugs, that's a foreign currency. Absolutely, we do. And that's a part people also leave, right? So the more, we can't print out of that. That's a fact. So we do, and that's something people still, again, on this bond trade, I hear that a lot. Well, we can print our currency. You can't print hips and knees. You can't print drugs. You can't print doctors. No, you can't. That's a foreign currency. We owe baby boomers $35, $40 trillion in a foreign currency.
Sure. In that sense, everyone's in Argentina. But financially, I'm just saying that, the U.S. does not owe pesos, that Argentina owed dollars. So, okay, so what does the stock market do?
So what's the stock market do? For the period of time until, as long as we stay in this dollar up, rates up dynamic, the stock market probably mean, it's not good for the NASDAQ. It's not good for the banks. I think it will increasingly be good for, you'll see a vicious sector rotation that we've been seeing towards industrials and commodities, et cetera. Ultimately, it's super good for the stock market, right? Argentine stock market in pesos went to the moon. And because again, the balance sheet's not there.
But you're not Argentine, inflation was like 60%. You're not forecasting that for the US.
No, not yet.
Yeah.
Not yet. But, again, it'll probably be like everywhere else. It'll be, as I've said, Argentina with US characteristics. It'll be, they have to get, the only thing keeping the US out of a fiscal crisis was the inflation the Fed has been fighting. That's why that was the mistake. That's when they broke something. And now we're just seeing it mark to market.
So this will be, the environment you envision will be good for stocks.
Ultimately, yes. In the short run, no.
Got it. Okay, so we know your view. You're bearish on short-term. You're bearish on long-term rates. That view has aged very well. What about short-term rates? If you think the Federal Reserve is going to cut rates, the 2-year probably looks pretty attractive. What do you think?
Probably, but to me, we've been recommending this whole time, short-term treasuries. Like I've been, recommending this barbell approach since the last, I don't know, clients probably know better than me, probably much of the last year, where, we're probably more than the last year. At any rate, overweight cash, overweight short-term treasuries, significantly overweight gold, significantly overweight Bitcoin, significantly overweight U.S. electrical infrastructure, overweight industrials, overweight oil. And so, yeah, look, if the Fed cuts rates, will short-term treasuries do well? Yeah, probably. Will they do as well as gold, Bitcoin, and oil? No. Especially with oil, if they have to cut rates, as I think they're going to have to with oil at 90 plus, or and maybe they don't cut rates, maybe they just do, the latest iteration of not QE, whether it's Treasury buybacks or BTFP or not QE or whatever. The market functioning purchases of treasuries that aren't QE, please don't, please let us keep our credibility, not QE. Yeah, it's gonna be great for oil and gold and Bitcoin. I don't think it's gonna be great for, I think it'll be fine for short-term treasuries if they cut rates. I just don't think it's the optimal way to express it.
Why does gold do well in this environment and Bitcoin?
Oh, because they are simply longer duration assets with a more fixed supply and a face value that can rise. They do well when a nation has a fiscal problem. And when the reserve currency issue of the world and her allies all have fiscal problems, and hers is hers is at least as bad and probably worse than the others, even Europe, then that's really good for gold and Bitcoin.
What about, do you think is Russia selling gold to fund its war?
They're not selling gold. They sold some gold earlier this year. They bought it all back. The latest update last week was their holdings were back to 2023 highs.
Okay, interesting. How come gold isn't up more?
Oh, that's a whole different, that's a complicated story. Gold is a very politically managed metal.
But Bitcoin is not.
No, Bitcoin's much less managed. And I think Bitcoin responded to last year's liquidity draw very aggressively.
So, but the monetary future that you envision does gold and Bitcoin play a role as a medium of exchange? In other words, going back to the gold standard or going forward to a gold standard or going forward to a Bitcoin standard? Or is it more like it's a call option of the dollar? Fiat currencies are really performing like trash. So let's just get something where the denominator is fiat currency. In other words, but what I'm saying, my question is, how do you exercise that call option? Like, are people going to be going to the store to, buy coffee with gold or Bitcoin?
The answer to the last question is no. The answer to the first question is, earlier you said the Fed will lend the money to the banks to buy the treasuries, or it'll get bought, somehow that way. Yeah. That is not the primary reserve asset of the world anymore. Would you sell finite oil production and store it in treasuries that are being bought by the banks who are getting the money from the Fed, who is creating that money out of thin air? No, you can't. You away from any political and economic, mathematically, you can't run a system that way. The system will collapse. And so what is needed to address the supply-demand issue in treasuries will force a systemic change, and not only will, is forcing a systemic change by which gold has become the primary marginal reserve asset and has been for 10 years already. Since 2014, global central banks have not added treasuries. I think they've sold $600 billion treasuries, $600 billion worth of treasuries on net at the central bank level since 3Q14, and they've bought about $300 to $400 billion worth of gold. And a lot of that was last year after the U.S. sanctioned Russian FX reserves. So this isn't speculative that gold will be moving back into the system as a reserve asset. Gold has been, is, and will continue to, driven and enforced by peak cheap oil. You can't sell more and more expensive oil or oil that's more expensive. Take your dollars or whatever currency you sell it in and store them in sovereign debt whose value declines against oil. You're better off just storing the oil, keeping the oil in the ground. And so you have to have a reserve asset that can rise in price or either rise in face value, rise in price, or have the rates rise enough to compensate you for the inflation in energy. And the reality is sovereign debt can't rise over $1,000 face value. And the reality mathematically is that the U.S. Treasury cannot afford interest rates over, I don't know what it is. I would argue we're already there, but maybe it's 6, maybe it's 7. I don't know. It's not too much further beyond that. I would argue with tax receipts already down 20 would tell you they can't afford 5. So yeah, you're already transitioning to this system. I think it will continue. And how do you get out of that trade? I plan on selling my gold to JP Morgan, and they'll credit my bank account. And I suspect it'll probably be a lot higher price because it's going back into the system.
And how do you do you think that the reserve currency will still be the dollar, or will it be another fiat currency?
I think it'll still be the dollar, but it'll be a much more. It'll be the fix to what Russia and China are doing, are just moving the system to what it should have been after World War II. And they said that the PBOC said that 15 years ago. They said the system at the end of World War II, there were 2 choices: the Keynes's Bancor system, where there was a neutral reserve asset made up of commodities, and then there was the dollar. And we went with the dollar. And the fact that the dollar, we've had all these crises, et cetera, shows that we should have gone with the other one, and we're going to move back to this other system. Like they told you that 15 years ago, and their actions have shown that they're moving back towards that. So I think we're moving back to dollar's global reserve currency, but primary reserve asset's going to be gold at a floating price in all currencies.
That's very interesting, Luke. Thank you for sharing your perspective. Before you go, tell us about Forest for the Trees. What are your different offerings, and do you just have one offering, or are there different sort of tiers? And where can people find your work?
Yeah, there's different tiers. We've got a mass market business. We have a institutional business, and you can find out more about us, fftt-llc.com, and you can also find me on Twitter at Luke Gromen, LukeGromen.
Yep. People know you on Twitter, and we got your handle on there. Luke, thank you so much for joining, and thank you everyone for watching.
Thanks for having me on.